Well, good morning. Let's go ahead and get started. Welcome to Williams Mullen's annual benefits forum. We are really so grateful that you have taken time this morning to spend a couple hours with us talking about benefits trends, and you could be doing a lot of other things. And so we really are grateful that you're spending time with us. I'm Brydon Dewitt. If you don't know me, I'm a partner in our employee benefits and executive compensation practice. And this year's theme is benefits trends for a resilient workforce. Normally these benefits forums, we are giving you updates on the latest regulations or the latest statutes and go through excruciating detail of the details of the various regulations and statutes. And don't worry, at least in my portion, we'll do some excruciating detail. But really what we're talking about this morning are just to provide you some legal insights on emerging trends in employee benefits and give you some ideas of how you can adapt your employee benefit programs to the needs of a modern and evolving workforce. Over the course of the program, our attorneys will explore 5 critical areas that employers should be watching closely: healthcare access and affordability, mental health and well-being, financial well-being, upskilling and reskilling in the age of AI, and family benefits. And I think I should have been moving. Yeah, there we go. Before we begin, we're going to be using Slido as our polling platform and Q&A platform today for both our in-person and online audiences. Scan the QR code or go to slido.com with event code 35102104. You'll see 2 tabs in our session: Q&A on the left and polls on the right. We will answer all questions at the end of the program, time permitting. When submitting your questions, please include your full name and email address. So if we aren't able to get to your question during the program, we can follow up. Your name will not be announced. There are no bad questions, but don't worry, your name will not be announced if we cover your question live. For those of you in person today, if you prefer to ask your question to our speakers directly, we'll stay after the event. Our contact information is also listed in the presentation slides, so you could also welcome to email us. For our online attendees, if you're having any audio or technical problems, please use the same Q&A in Slido, and our marketing team will assist. This program is being recorded. Watch for a follow-up email this afternoon that contains links to our presentation materials, an event survey, and a recording of today's event. You'll also receive a link to download your SHRM attendance certificate. This program is valid for 2 hours of SHRM credit for all attendees who stay with us for the program's entirety. So we're going to do our first poll so that we can all learn a little bit about using Slido and learn something about our guests today. So our first poll is: my employer is A, a publicly held company, B, a privately held company, C, a university or school, D, consulting firm, or E, other. And I see people are already putting in their answers. If just please use the poll tab on Slido to submit your response, and be sure to press the green send button to record your answer. So we have 19. We'll just give people a chance online to provide their answers. Looks like we have a lot of 63% of privately held companies. Okay, let's get on to our next question. Our next question is: my title is closest to benefits manager, HR director, CFO, finance director, general counsel or attorney, consultant advisor, or other. Yeah, we have a lot of HR directors in attendance, 43%, 20% benefits managers. So about 70% are folks who work in HR and benefits, and then a few consultants. All right. Let's move on to our first topic, which is mine, healthcare access and affordability. First, we're going to do let's do a little poll first. True or false? An employee can participate in both an HSA and an FSA at the same time. We're getting really good responses, and it depends is right. Really, when you ask an employee benefits question, an ERISA question, it depends is probably the right answer. Just given that, but as we'll get into later, the coordination between HSAs and FSAs, the question is whether your FSA defeats the individual's HSA ability to participate in the HSA. If an FSA is limited purpose or post-deductible, then you can actually have both. All right, next question. An FSA may offer at the same time both a grace period and a carryover. Okay, actually the answer here is false. So an FSA, if you have a health flexible spending arrangement, you have to choose whether you're going to have a grace period or a carryover or neither. But a plan cannot carry over funds from one year to the next and then also have a grace period. Okay, so let's get into my section here, healthcare affordability. And I thought, a way for employers to help employees deal and cope with the high costs of health insurance or medical expenses are some of the tax advantage accounts that are available in their Internal Revenue Code. And a lot of this, again, is not breaking news. These aren't new regulations. But I thought it would be good to review them and review how they interact. And so we're going to talk about health savings accounts, health flexible spending accounts or health flexible spending arrangements, and health reimbursement accounts. And all three of these types of accounts, kind of provide basically the same idea that contributions go in pre-tax or not taxed in the case of an HRA. And then if distributions are made for Code Section 213D medical expenses, those distributions are tax-free. So that's just a common benefit for all three types of accounts. So let's start first with an HSA. An HSA really is not an employer, hopefully not an employer plan. It doesn't belong to the employer. It's really like an individual retirement account for health expenses for an employee. So the account is owned by the employee. If they terminate employment, they still have their HSA. It still belongs to them. And you can just accumulate money in an HSA over years. Unlike an FSA where you have to use the account during the plan year, HSA funds can stay in the HSA. And if you save your receipts, if I have a doctor's visit this afternoon and I save the receipt, when I'm 65 or older, I could turn in that receipt and get reimbursed from my HSA. So it's like an IRA, and some people really view HSAs as a retirement vehicle for that reason. And the earnings in the HSA are tax-free as long as the distributions are for medical expenses. Again, I've mentioned is an employer plan. So generally an HSA is not an employer plan, but it can be, or an ERISA plan. So an HSA is not an ERISA plan if if employees participate totally voluntarily, they don't have to participate. And then the employer does not prevent employees from moving their HSA funds from the custodian chosen by the employer. So usually plans, especially if you run it through a cafeteria plan, employees will make their pre-tax contributions to the HSA, and the employer has established an HSA custodian to receive those funds. If the employer requires the funds to stay with that custodian, then the HSA would become an ERISA plan. If the employer imposes rules in addition to those imposed under the code as to the utilization of the HSA, the HSA becomes an employer plan. If the employer makes the investment decisions for the HSA or imposes undue influence over the investment of HSA funds on the participants, you have an ERISA plan. If the employer, and this is where maybe some of us get caught, if the employer represents that the HSAs are an employer welfare benefit plan maintained or established by the employer, it may be an ERISA plan. Or if the employer receives any payment or compensation in connection with the HSA. But that last bullet point is important. So you need to be careful about how the HSA is described in summary plan descriptions, in newsletters, in open enrollment materials. If it looks like the HSA is an employer-sponsored plan, then it becomes one and subject to ERISA. So employees, who can participate in an HSA? So an employee must be covered only by a high deductible health plan on the first day of the month in which they are making contributions to the HSA. They cannot be covered by any other plan that is not a high deductible health plan. And you can get caught up on this if you have an employee who's covered by their spouse's plan. So maybe the spouse is covered by a non-high deductible health plan. That would defeat your employee's ability to make HSA contributions. If your employee is covered by your spouse, the spouse's general purpose flexible spending account, that can defeat, this happened to me, actually. My wife enrolled in a general purpose FSA, which affected my ability to make HSA contributions. Or if the employee is covered by a non-HDHP health reimbursement arrangement. The person may not be a tax dependent of another person and must not be eligible and enrolled in Medicare in order to make HSA contributions. So what is a high deductible health plan? Well, it is what it sounds like. It's a plan that has a statutorily mandated minimum deductible. So for 2026, for individual coverage, the deductible is $1,700 with $8,500 out-of-pocket maximum. And for family coverage in 2026, it will be $3,400 with a $17,000 out-of-pocket maximum. That said, some benefits, some expenses may be paid on a first dollar coverage. There are certain permitted coverages that do not defeat HSA eligibility, and there's a list here. But typically what you see with employers is they have they have dental, vision, accident coverage, long-term care coverage, your disability, short-term and long-term disability benefits, liability insurance, preventive care benefits, and certain EAPs, which we'll discuss later, that do not provide significant medical care or treatment benefits. Contributions to an HSA are also statutorily limited. So there's an annual limit, and then an employee's monthly contribution is 1/12 of the annual limit. So for 2026, the annual limit is $4,400 for self-only coverage, and for family coverage, it's $8,750. And then individuals who are 55 years old or older may contribute an extra $1,000, kind of like a catch-up contribution concept that we have with 401k plans. This next provision, though, is something that I've had to pay attention to recently. So there's a last month rule. So if an employee is eligible to contribute to an HSA in December, then he or she is deemed to have been eligible for the entire year, provided that they remain HSA eligible for the next 12 months. So if you could allow an employee who is hired in December or who switches to an HDHP in the 1st of December to make the entire $4,400 contribution for the year because they're deemed to have been eligible. But they only get that treatment if they then remain HSA eligible for the next 12 months. And I think that's really hard for an employer to administer, to keep track of. You're not going to know in December of 2026 for sure that that employee is going to be HSA eligible for the next 12 months. And so if your cafeteria plan allows HSA contributions up to the maximum permitted by law, well, technically they could contribute the full $4,400, but then you might have a problem if they change jobs or they drop out of HDHP coverage in the next 12 months. So that's just an administrative issue that you can allow this, but I think it may be really difficult to administer. And contributions may be made by the individual or the employer or anyone else. Employer contributions generally are subject to a comparability rule. So the rule is that every employee receives the same dollar amount contribution or the same percentage of the high deductible health plan deductible. But this rule does not apply if you offer the HSA through a cafeteria plan. So if your HSA is a part of a cafeteria plan where employees can make contributions on a pre-tax basis, then the general comparability rule for HSAs does not apply, but the cafeteria plan non-discrimination rules apply because your HSA is offered through a cafeteria plan. And then we have the one big beautiful bill that made some changes to HSAs. Now an individual who is covered by a direct primary care arrangement, and I think this is kind of like what Partner MD does or concierge medicine, where you pay a monthly fee and then you have access to the doctor. That does not defeat HSA eligibility. Receiving telehealth and other remote care services before meeting the deductible does not defeat HSA eligibility. And if you're enrolled in a bronze or catastrophic health plan offered through an ACA marketplace, that does not defeat HSA eligibility. Okay, let's move on to health flexible spending arrangements. One of my favorite types of benefits. So these are creatures of Section 125. So Section 125 of the Internal Revenue Code provides the rules for cafeteria plans where employees can elect to receive tax-free benefits, certain qualified benefits in lieu of cash. So as a cafeteria plan benefit, an FSA must be a part of a written plan document. It's subject to the mid-year election changes, restrictions. So generally an employee's FSA election is locked in stone for the entire 12-month period unless they have a change in family circumstances, change in status. FSAs are subject to the cafeteria plan non-discrimination requirements, and only employees may participate in the FSA. You may not have thought about this, but an FSA is a Section 105H self-funded or self-insured medical reimbursement plan. So a health FSA is subject to the Code Section 105 non-discrimination requirements. It's also, unlike an HSA or an HSA that hasn't been endorsed by the employer or met those other requirements I mentioned, is subject to ERISA. So a health FSA must have a summary plan description. It's subject to annual reporting on Form 5500. It's an ERISA plan, subject to ERISA claims procedures. And so, often we'll see HSA, flexible spending arrangements folded into a comprehensive welfare benefit plan. So the employer is filing 15500 for medical, dental, vision, and health FSA. A dependent care FSA, by the way, is not an ERISA plan. So dependent care FSAs are not subject to ERISA. This next one's a little annoying. A health FSA is subject to the HIPAA privacy and security rules because it is a self-insured medical reimbursement plan. So technically, you should have a HIPAA privacy policies and procedures for a health FSA. You should have a HIPAA security, electronic health information security policies and procedures, business associate agreements with your provider. If you use Flores or one of the other FSA providers, you would need a business associate agreement under HIPAA because a health FSA is a medical plan. So you're subject to the HIPAA rules. And it's also subject to COBRA, kind of. You have to offer COBRA if the amount the employee could receive in reimbursements for the rest of the year is greater than the amount the employee is required to pay into the FSA. So these plans are technically subject to COBRA under certain circumstances. There's a uniform coverage rule that if I elect $3,000 for my FSA for the plan year beginning January 1, and I have a $3,000 expense on January 2nd, I can get the full $3,000 out of my FSA. This puts employers a little bit at risk because I could then quit on January 4th and have received the $3,000 and never put hardly any money into my FSA. That's not the same with dependent care FSAs, where you are limited to the amount that you've put into the account during the year. And I think we're all pretty familiar with the use it or lose it rule for health FSAs. So if you do not use the money generally in your FSA by the end of the plan year, that money is forfeited. But there are some exceptions. So there is a 2.5-month grace period option where you can incur expenses during the first 2.5 months of the next plan year and have those expenses reimbursed from your leftover account balance from the prior year. There's the carryover. It used to be a $500 carryover, and it's been indexed for inflation to track the FSA contribution limit. And I don't recall what the current, it's like $650, $675 this year. It started at $500 and then $550, and it's gone up. So you can have a carryover amount that goes from one year to the next that you can then use throughout the entire. It just adds kind of to your balance for the next year. But as we learned in our Slido poll, you cannot have both a grace period and a carryover. So if you're going to offer this relief, you have to pick one or the other. So what do you do if you end up with forfeitures in your FSA? So the IRS regulations say, and I think some people are caught on this, the IRS regulations say that they may be retained by the employer. The employer can keep the leftover FSA money. It's right there in black and white in the IRS regulations. The only problem is the IRS doesn't regulate ERISA. And this is an ERISA benefit. This is an ERISA plan. The FSA forfeitures are ERISA plan assets. And so ERISA does not allow an employer to just take back money that's especially money attributable to employee contributions. So retaining FSA funds is not permitted by ERISA, no matter what the IRS says. So that's an easy trap. And in fact, I've seen this written into cafeteria plan documents. It's not permitted by ERISA. So the other options are permitted. You can offset salary reduction contributions in the following year on an even and equivalent basis, not based on, if I didn't use 500, I get a $500 credit. It would be, you take the entire account amount of the forfeitures and then equally allocate. So it's not kind of like one-to-one, so that I benefit from not having used my FSA. You can return employees on an equal basis. Again, you can pay it out to the employees. You can increase annual coverage amounts, or you can defray plan administrative expenses. So that's what you can do with FSA forfeitures. Contributions are now limited in 2025 to $3,300. Employers can make contributions to health FSAs, and I'm not aware of any of our clients, if you are out there and you're doing this, let me know, who actually make their own contributions to the FSA. But to preserve accepted benefit status, which is really important for ACA purposes, the maximum contribution that an employer can make to an FSA is the greater of 2 times the employee's election, or $500 more than the employee's election. So I think generally what employers who do this do is they make just a contribution up to $500 above the employee's election to the FSA. And this does not count against the $3,300 maximum limit. So let's talk about how health FSAs can coordinate with HSAs. Again, HSAs, to be eligible to contribute to an HSA, you cannot be covered by any plan other than a high deductible health plan. So a general purpose FSA that provided first dollar coverage for medical expenses would defeat an individual's ability to make HSA contributions. So the proposed cafeteria plan regulations provide these 3 options, where you can have a limited purpose FSA that only covers permitted coverage, such as dental and vision coverage, and that's the rule for the entire year. Or you can have a post-deductible FSA that only makes reimbursements after a participant reaches their high deductible under the group health plan. Or you can have a combination where until the participant reaches their high deductible limit or has paid that deductible, the FSA only covers dental and vision expenses, and then it goes wide open once they've reached their HP deductible. And one thing you might be thinking about is, well, what about that grace period? So what if I have a 2.5-month period after the end of the plan year to incur expenses and to pay those expenses with money left over from the prior year. And in the prior year, I was not in a high deductible health plan, but this year I am, and I want to make HSA contributions. Well, that can be an issue. If you administer the grace period as a general purpose FSA for those months, those first 2.5, or I guess the first 3 months into the next year, the individual would not be allowed to make HSA contributions. So a way to get around that is to either treat the FSA as a limited purpose FSA for those first 3 months, or just the individual cannot make HSA contributions until the end of the grace period. But that's something to pay attention to if you're running your HSA through a cafeteria plan, to make sure that if you have a grace period, the way the grace period works doesn't make your participants ineligible to make those HSA contributions. And let's talk a little bit about health reimbursement arrangements. So the health reimbursement arrangement is really like a self-funded employer medical reimbursement plan. All of the contributions are employer contributions to a health reimbursement arrangement. There are no employee contributions permitted. Account balances, unlike an FSA, account balances in an HRA may roll over from year to year. So you can accumulate money in your HRA. And usually an HRA will say, we are setting aside, each employee has $5,000 or $10,000 of medical expenses that they can incur each year, and then whatever's left over rolls into the next year. HRAs are subject to ERISA. They are ERISA medical or welfare benefit plans. So 5,500, summary plan descriptions, claims procedures, all of the ERISA requirements apply to health reimbursement arrangements. They are also subject to COBRA. They are subject to HIPAA again. So if you have an HRA, the HRA needs to have written HIPAA privacy policies and procedures and comply with the HIPAA electronic PHI security rule. They are also subject to Code Section 105H. So if you have an HRA, make sure that the eligibility rules, that either it covers 70% of employees of the control group, or it covers a non-discriminatory reasonable business classification of employees. And then all benefits under the HRA must be the same. So everybody must receive the same annual permitted maximum medical reimbursement. And then the really sticky part is the Affordable Care Act. So these plans are subject to the ACA. You have to have a summary of benefits and coverage, just as you would have with your Cigna or Anthem group health plan. And in order to comply with the Affordable Care Act, an HRA must be integrated with the employer's group health plan. So this is because the IRS treats HRAs and even FSAs, if you fail that accepted benefit rule that we discussed earlier, treats them as group health plans subject to the Affordable Care Act. And by definition, an HRA violates the Affordable Care Act because an HRA has an annual maximum reimbursement limit. And that annual limits and lifetime limits are prohibited by the Affordable Care Act. So, but for this integration rule, an HRA would risk imposing the employer being subject to $100 per day per participant penalties under the ACA for violating the ACA's coverage mandates. So the IRS has provided a way to provide an HRA called integration. And so under the integration rules, an HRA must only be available to employees who are actually enrolled in the employer's group health plan. So you're kind of piggybacking off of the employer's group health plan. The group health plan complies with the ACA, and so the HRA is just an additional tack-on benefit. And then under the terms of the HRA, the employee is permitted to permanently opt out and waive future reimbursements from the HRA, at least annually, and upon termination of employment. And I think this rule is here to help the employee qualify for the premium tax credit if they go to an ACA marketplace. So an employee may say, your HRA is making me ineligible for the marketplace coverage, so I want to opt out. So there are actually several pages of regulations on integration, but this is really the key elements of integrating an HRA. So be careful if you're going to offer an HRA, it's really important to make sure that you meet the integration requirements under the Affordable Care Act. And then coordination with an FSA. So health flexible spending arrangements are not allowed to reimburse expenses if those expenses are reimbursable from another plan. So that means that usually an HRA must be the plan that reimburses expenses before the FSA. If you don't like that result, then you can amend the HRA or draft the HRA to provide that it does not, no expenses are eligible for reimbursement under the HRA until the FSA is exhausted. So really it's a plan drafting issue. And of course, you can't double dip. You can't have a single expense reimbursed under both your FSA and your HRA. And then make sure your HRA does not prevent employees from making HSA contributions. So you can have a limited purpose HRA covering only dental and vision preventative care expenses, or have a post-deductible HRA, or you could do just like with the FSA, have a combination where the HRA only reimburses dental and vision expenses until the individual reaches their high deductible limit, and then the HRA opens up. And so reimbursable expenses under health reimbursement arrangement, only expenses incurred after you've established the HRA, 213 medical expenses, long-term care expenses, if the maximum reimbursement available under the HRA does not exceed the value of coverage under the HRA. And if you would like to have an HRA that reimburses long-term care expenses, you really need to call me or another competent counsel because making sure that the HRA the value of the HRA does not exceed the maximum reimbursement can be a little tricky. It can cover, just like FSAs, over-the-counter drugs and menstrual care products, COVID-19 testing and PPE expenses, as well as medical travel expenses. So let's look at a kind of a subset of health reimbursement arrangements. So before the Affordable Care Act, some smaller to mid-sized employers, really smaller employers, the way that they would provide health insurance is just say, okay, employees, go out, find your health insurance, and we will reimburse the premiums. So employees would go out and get individual coverage, and the employer would reimburse the premiums. And the IRS decided that that arrangement is called an employer payment plan, which is a group health plan subject to the ACA and violates the ACA. So employers couldn't do that anymore. And so under, I believe, the first Trump administration, the concept of an individual coverage health reimbursement arrangement was created. And so an employer through an ICHRA can reimburse employee individual insurance coverage premiums. But of course, you have to jump through some rules. The individual must actually be enrolled in the individual coverage. All employees in the same classification must be offered either ICHRA coverage or group health plan coverage. So employees are not allowed to have a choice between having group health plan coverage or the ICHRA. And the rationale here is with the IRS didn't want employers to kind of offload their high claims individuals in their group health plan onto an ICHRA. So the employer at the outset has to decide this classification of employees gets our group health plan. This classification is not eligible for a group health plan, but they can have the individual coverage health reimbursement arrangement. So the idea here is that what you're doing is you're integrating the ACA, the ICHRA with individual coverage. So to be integrated, all covered employees must be enrolled in individual market coverage. Again, the same classification of employees must not be offered a choice between ICHRA and traditional group health plan coverage. The same terms must apply to all employees in the same classification. And individuals must be allowed to opt out of the HRA at least once per plan year, just like the integration for regular HRAs. You must substantiate the employee is actually enrolled in individual market coverage, and you have to provide a notice to the employees at least 90 days before the start of the plan year. And then when I was doing research on this topic, I came across, this is something I'm not aware of any of our clients doing, and I hadn't really thought about before, but this concept of a health payment account. And it's really like a line of credit for health expenses. So you have an employee that has, they're under a high deductible health plan. They have to do a medical procedure, and the cost is $2,000. And that's really too much for the employee to be able to pay all at once. Well, the employer can provide this health payment account where the employer will front the money, pay the $2,000, and the employee pays back through payroll deductions over time the $2,000. I thought it was a really interesting concept. I was thinking, well, it's an interest-free loan? Is that taxed? Maybe not, because it's a medical expense reimbursement. But it's something that I thought was really intriguing to help employees get the care that they need and help them deal with that. Another thing I want to discuss is telemedicine as a way to cut costs. Telemedicine visits are less expensive than going to a doctor, and it takes less time. So employees lose less time from work, less time from their lives. They're more likely to use telemedicine than make an appointment and drive to the doctor's office. There's a potential that it's a higher cost because they see a doctor online and you pay that amount, and then the doctor says, well, I really need to see you in person, and now you're kind of double paying for the same care. But overall, telemedicine seems like it saves time and money and increases employee productivity. So it's something to consider. And it also doesn't defeat HSA eligibility, as we discussed earlier. And then really a big part of healthcare affordability is employee education. Is helping employees understand how to utilize the plan that you're offering, what the benefits are, when they should go to the ER, when they should go to their doctor, how to shop for providers, be good consumers of healthcare. And often, one of the best things is to have kind of testimonials on your website, especially from high-ranking people in the organization that talk about how, if they're willing to discuss their medical issues. I had this situation, I had to have an MRI, and I shopped around. It would have been $4,000, but then I found another, a shop or a place that I could do it for $2,000 and got a better result. Things like that. Just be intentional about educating people, your employees, about their plans and the way to utilize healthcare. So Patty told me that I am way behind. I only have 10 minutes left. I'm going to skip the Slido. We'll talk a little bit about mental health and well-being. These numbers are not good. So 76% of US workers reported at least one mental health symptom. 84 respondents said their workplace contributed to at least one mental health challenge. And 81% of workers say they are looking for workplaces that will support their mental health in the future. The American Psychological Association reported that a 2017 study found that the cost of job stress nationwide was up to $187 billion, with 70 to 90% of losses resulting in lost productivity. But you think that 84% of the respondents said their workplace contributed to at least one mental health challenge. And I don't know, are workplaces getting more stressful? Is life just more stressful? Is it that, or maybe it's maybe things haven't changed, but boomers and Generation Xers just wouldn't complain. They would have said, I was telling Andy, they go home and drink a 6-pack, right? And they don't complain. And they were always having the stress. So maybe it's always been there. But workers are they're reporting that there are mental health issues in the workplace. And so I found this, the U.S. Surgeon General's framework for workplace mental health and well-being. Pretty interesting study. And again, I'm kind of skipping along here. But the idea here is really not from a benefits perspective, but it's to create an environment, a culture at work where employees feel safe and secure, they feel heard, they feel part of a community, they feel belonging, they feel a sense of contributing, they feel that they are appreciated. It's an interesting study. You can find it from the U.S. Surgeon General, just providing employees just a better culture at work. This isn't benefits you're offering, it's just the culture of the workplace. And then the American Psychological Association had similar recommendations where you train managers to support employees and recognize employees who may be having issues. provide employees more flexibility about when and where they work, re-examine your health insurance policies. Does the health coverage address mental health, mental well-being? And then listen to get feedback from employees, survey employees, and find out how they are feeling, what they would like, what could help them have a more healthy work environment, and then review the equity, diversity, and inclusion policies so employees feel that belonging and feel that they're accepted at work. But another way to address this is through employee assistance programs. And we're all familiar with EAPs that can offer consulting on fitness and nutrition, referrals for counseling and mental health counseling, substance abuse disorder benefits. But EAPs are kind of a little ticking time bomb in the benefit worlds that I think are maybe overlooked. An EAP can be an ERISA welfare benefit plan. So if the EAP provides medical care, mental health counseling is medical care, the EAP is an ERISA plan that the employer is offering. An ERISA plan subject to all of the ERISA requirements, right? So the Department of Labor has taken a couple of advisory opinions that I wanted to put up here to show you the difference. Really, the difference is where an employer has a counselor trained in mental health, providing counseling to employees, providing those services, you have an ERISA plan. If you have someone who is not a trained mental health professional, but they do kind of triage and refer employees to outside mental health professionals, it's not an ERISA plan. So you have to look at the extent to which your EAP is actually providing healthcare versus just kind of providing a referral or an advocate to help someone navigate the medical profession. Again, if it's subject to ERISA, you have all the ERISA requirements. You have to have written plan document, summary plan description, Form 5500 if there are over 100 participants, the broker fee disclosure requirements cover the whole slew of requirements. And then you also have the ACA issue. Is this a compliant plan under the ACA? To avoid ACA treatment, the EAP must be an accepted benefit. And to be an accepted benefit, it cannot provide significant benefits in the form of medical care. So limited counseling is probably okay, but to the extent that an EAP is really providing medical care, you have an Affordable Care Act problem because now you have a group health plan subject to the ACA. And that's also the rule for HSA eligibility. Your EAP, you have to be careful that your EAP doesn't prevent your employees from contributing to an HSA. So I just feel like EAPs are just kind of is an issue that kind of is lingering out there that we aren't necessarily paying attention to that could trip you up.
Brad, what if your EAP is just wrapped in with another benefit? It comes as part of your health plan, you're not paying for it. It comes as part of your life insurance plan. It's just they just wrap it in as part of.
Well, as part of life insurance, then you have a group health plan also along with your life insurance plan. So I think if it's part of the life insurance plan, you have the 5500 requirement probably met because it's part of that plan. But the ACA issues, HSA coordination, those issues are still there. COBRA, you'd have to offer COBRA if it's an ERISA plan. Offer COBRA for your EAP. Then the final thing that I'm not going to talk about because I'm out of time, are paid leave banks. So one of the mental health, giving people flexibility. Generally, if you have a paid leave bank, the donor employee is taxed. Even though they're donating the leave, they're taxed on the value of the leave that they've donated. But there are two exceptions for leave programs for medical emergencies and leave sharing programs for major disasters that are declared by the president. And talk about slogging through requirements. This is what I promised I would, but I don't have time. So, but just know that there are, under these, if you meet these exceptions, then the recipient is taxed at their rate of pay and the donor is not taxed. So those are two exceptions. Somebody is being taxed, right? they're getting their money, but it's who's going to be taxed, and there are these two exceptions. And so I'm way over my time, so I invite Marc up to talk about financial well-being.
I'm just going to check technology. Okay. I know how to work the buttons. So thank you, Brydon, and welcome to all who are here in the room and all who are joining us online. For those who don't know me, I'm Marc Purintun, and I'm a partner here at Williams Mullen, and I'm the chair of the Employee Benefits and Executive Compensation Group. And I'm delighted to have you join us. So let's start with one of those questions from Slido. I hope you know how this works, because I don't quite get it. But what does financial well-being mean to you? Go ahead and tell us. Freedom to enjoy life, that's fantastic. Stress? So I'm not sure that we put the list in ranked order, but it does look like that's how it comes out as people are responding. No stress over finance is fantastic. Freedom to enjoy life also, does seem an important part. And if you have financial well-being, you may feel free to enjoy your life. Sufficient savings. Honestly, we're going to talk about that. That's a significant part, especially when you're thinking retirement plans. Retiring on time or early. I think we all aspire for that, but I'm surprised how many people have told me that they're going to work until they're 70 or more. So you never know. No debt. That one's hard to accomplish unless you rent, or you've paid off your mortgage. I'm not sure. So. This portion of our presentation will focus on financial well-being, and I'll cover why employee financial well-being has become a hot topic for employers, for the government, for employee plan service providers. To address the concerns that people have, legislation action has occurred, financial education is being provided to participants regarding their plans, retirement plans, broader financial wellness programs are being drafted. There are numerous surveys that focus on employee concerns about financial health. I know Brydon was mentioning a couple that had to do with healthcare related issues, but there's a lot out there about financial health and financial well-being. And we're going to review one recent survey that kind of falls similar to one that Brydon just mentioned. Reviewing these surveys and the related articles has pushed me beyond my comfort zone of ERISA and ERISA covered plans to think about something that's beyond standard ERISA benefits, and to understand or consider the importance of financial well-being and broader wellness initiatives as a necessary part for the well-being of employees and their productivity at work. So here's the survey I mentioned. This survey comes from Franklin Templeton, the Voice of America Workplace report for 2024. So it's pretty recent. I don't think there's anything out for 2025 just yet. 96% of workers indicate some type of financial concern related to income, retirement, health. All of those are primary concerns. Brydon picked up on some of the health-related issues. 66 report negotiating their current expenses during due to the current economic climate. So climate's up and down. People feel like they have to refigure what they're going to be paying for, what they can afford, what they're not going to afford. 64% report rising healthcare costs make it a challenge for them to cover everyone in their family. That's a difficult choice, I'm sure. 61% report their financial independence is in jeopardy due to the current economic situation. And 59% are concerned about running out of money in retirement. I swear I hear this frequently, even though I work in retirement all the time, and I think everybody should be saving every single penny they can. Obviously, not everybody has, or maybe they have, but that doesn't feel like it's enough. And sometimes that has to do with not fully understanding financially, what does that mean to have enough for retirement? And part of financial wellness and financial education information is helping people understand what they might need and what resources they might have. I think most of us are familiar with several of these concerns, and the report highlights how such concerns can distract employees and result in absence from work, which is obviously a problem for employers. This next slide, it took me a long time to figure it out because I was distracted by the colors and the numbers. So I'll just tell you, they asked this question: what is important for the following to you? So which of these is most important? On the left, it's the left. On the left is financial wealth, middle is mental health, and the right is physical health. And the colored bars relate to the years 2022 is blue, 2023 is green, and 2024 is red. What's noteworthy is for the first time ever in 2024, financial health is the most important in this area. And that's a 15% jump from the prior year. And this occurs all while the other concerns also remain relatively high. So obviously, employees who are being interviewed are very concerned about financial health. As a result of rising financial concerns, the government, employers, and employee benefit providers have taken steps to address employee concerns regarding financial health. Beginning with the Secure Act in 2019, followed 3 months later by the CARES Act, which came out in March, just at the beginning of the COVID-19 pandemic shutdown, and followed by Secure 2.0 in 2023, Congress has acted to address financial concerns of American workers through increased retirement participation and addressing causes of financial stress, such as student loans, unforeseeable emergency, and the need to access plan savings. In this approach, Congress has used a two-prong approach. To incentivize participants to work-based retirement plans, Congress took this two-prong approach first to make it easier for participants to get into the plan, sometimes by automatic enrollment, but we'll talk about that in a bit. And the second prong is to relieve people's anxiety about, you put me in this plan and they're taking money out of my check and it's going in there, and what happens if something bad happens? They've expanded access to the savings that are in the plan for certain situations and circumstances. And these are limited access, but they're pretty fulsome broadly. The following are major changes to retirement plans from Secure Act and Secure 2.0. Long-term part-time employees. Those are people who've worked under the Secure 2.0, 500 hours in 2 consecutive years. They must be allowed to make elective deferral contributions into your 401k or 403b plan. That doesn't mean that they are going to get an employer contribution, either a match or a non-elective contribution. Plan may allow that, but they must be allowed to make deferral contributions. And that builds retirement savings, even for the most part-time employees. 500 hours a year is about, is it 15 hours a week over averaged? 20 hours a week over average is 1,000 hours. So maybe it's closer to 10 hours a week, but it's still, allowing people who may be long-term employees an opportunity to save for retirement. Wait, I think I jumped ahead. I did. Student loan repayments by employees may be treated as elective deferral contributions in a 401k plan, and therefore matched under the 401k plan. So you're not making the repayments to the 401k plan, but you're reporting to the 401k administrator that the repayment has been made, and then you're eligible to get a match. And this is all animated by concerns of many people who have high student loan debts who weren't able to balance both, making big student loan repayments every month and also putting money away for retirement. This allows them to actually receive the same benefit that others would receive because they made elective deferral contributions. As we'll discuss later, employers can now also reimburse employees or pay directly student loan payments that have been made. Catch-up contributions. As someone who falls into this age group, I'm very happy about this. Increased catch-up limit for a select portion of the workforce, but people who are age 60 to 63. So even if you're in your 63rd year, at some point during the year, you're eligible to make this enhanced catch-up contribution. I think regular catch-ups are up to 7,500 this year. This is 11,250, which is indexed for inflation. Automatic enrollment for new plans. Effective as of the date of enactment in 2023 for Secure 2.0, all new plans, 401k and 403b, must have an automatic enrollment feature. And that feature is going to have deferrals beginning somewhere between 3% and 10%. I don't know anybody who starts at 10, but I know people who are aggressive and they start at 8. But and then has an auto escalation feature. So not just automatically enrolling people in it, but every year, unless they opt out, and they always have an opportunity to opt out, the amount will increase. And all the way back to the early 2000s, we've had government pushing automatic enrollment because it actually has increased retirement savings across the board in the United States. So this is just more of the same. The following are changes allowing employees to access their retirement savings. So this is that second prong. In certain limited situations. The complexity of hardships makes it just very difficult for plan administrators, and that has been eased by allowing participants to self-certify. I have a financial need. I'm in a financial situation that allows me to take a hardship distribution. So that was a real big bonus. I don't know any employer, there may be them, but most of the employers I know are just more than happy to be relieved of the requirement to gather that information to determine, do they really have a financial need? So we're going to trust our employees. Participants who are victims of domestic abuse can take distributions from their retirement savings without a 10% early withdrawal penalty. So these changes, I should mention, are optional. So employers can opt in. They don't necessarily have to, but they can opt in. So these distributions are permitted if the plan permits. If the plan permits, participants can draw up to $1,000 for an unforeseeable and immediate financial need related to personal or family emergencies, and there will not be a 10% early withdrawal penalty. Such amounts can be repaid within 3 years. The same is true for the domestic abuse withdrawals as well. Federally declared disasters would allow affected participants. So if the disaster's in Southern California and you live in Maine, you can't get that. But if you're in that area, then you could take a distribution and from the plan, and they're not subject to the 10% early withdrawal penalty. Plans may permit penalty-free distributions for individuals with terminal illnesses. And if the individual lives beyond a certain point, they can opt to repay the amount that they took out, maybe some miracle cure or whatever. But it's an opportunity in like the most difficult financial situation that's going to be addressed by the federal government. So the idea of emergency savings accounts sounds kind of great, but it's not really been popular with employers, perhaps because of the possible administrative burden. I don't know of any of our employers who have done this, but it would allow, you can see what Congress was trying to do. It would allow employees through payroll deduction to put money into an account, a limited amount that they would be able to take, say the car broke down on the way back home from work and you had to take it into the auto shop to get repaired. And they say it's going to cost you $1,500. Well, if you had an account like this, you might not have to dip into your credit cards. But so far, Brydon, wave if you know of anybody who's, no, I don't know of anybody who's done this either, but you could see they're trying. Whether it's actually going to work out, I don't know. But so retirement plans that permit participants to direct their investments are subject to certain requirements under ERISA. Whoops, I skipped one on the last one. Employers can provide small incentives for employees who elect to contribute to a 401k or 403b plan. So if you wanted to give a gift card, nominal amount at enrollment to just induce people to put money in the plan, that's permissible. So ERISA has a variety of requirements for plans that allow individuals, participants to direct their investments. Plan fiduciaries are generally responsible for the management and control of plan assets. Some individual account plans, such as 403b and 401k plans, permit participants to direct all or a portion of their account balance. I know some plans, the match is in a stock fund. They can't direct that. But most plans, they allow pretty much all the assets to be directed by the participants. ERISA provides relief, this is essential for plan fiduciaries, from investment losses that are the direct result of a participant's exercise of investment control, provided that the plan complies with the requirements of ERISA Section 404C. Those requirements include that the plan must provide participants and beneficiaries an opportunity to give investment direction at least once every 3 months. Participants must be given notice that the plan is intended to be a 404C plan and that the fiduciaries may be relieved from liability. And the plan must provide at least 3 diversified investment alternatives to represent a broad range of investment alternatives. And participants must have an opportunity to exercise control. Now, clearly, this seems really antiquated, and that's because the regulations were written decades ago. But, and the statute was drafted even longer ago, but it still works. Most plans I know have a broad range of investment alternatives. And so way more than 3, hopefully less than 300. There are additional disclosure requirements that are applicable to all plans. So even if the employer doesn't want to go through the hoops and say, I'm an ERISA 404C plan, ERISA section 404A requires that detailed disclosures must be provided on the investment options in the plan. And this includes quarterly notices about investment returns and investment fees, et cetera. I'm sure many of you have received these in the mail or in your email or an email saying, go look at it, it's there. And that's why we get our quarterly notices. The general principle for the 404A regulation, this is right out of the language of the DOL, so I'm just going to read it because they're trying to do something here. The regulation is that plan fiduciaries must take steps to ensure that such participants and beneficiaries on a regular and periodic basis are made aware of the rights and responsibilities with respect to investment of assets held in or contributed to their accounts, and are provided sufficient information regarding the plan, including plan fees and expenses, and regarding designated investment alternatives available under the plan, including fees and expenses of investment alternatives, and to make informed decisions with regard to the management of their individual accounts. It's a lot. They got to know what this is. That's part of financial education. And as a result, participant education is a big issue. And we talk about it a lot in investment committees, talking about the opportunity to help participants understand what the investments of the plan are, how they can make their investment decisions and investment choices. Beyond notice requirements of ERISA section 404C and 404A, best practices encourage education for plan participants to help them understand investments and financial principles that help them achieve their retirement goals. Helping participants better understand their investment options and investment principles helps participants wade through all of those papers, all of those emails, all of that information. Generally, ERISA fiduciary relief hinges on that the participant actually exercises independent control over their account assets. This is easier to accomplish when the participant understands what the investment process is. Providing broad-based participant financial and investment education will possibly reduce the risk of imprudent investments. We hope it does. We hope that they understand investing 100% of your entire account balance in ABC fund is not the best option, no matter how young you are, but it might work. As a consequence, the more favorable investment outcomes for participants may reduce participant decisions to sue their investment fiduciaries for breach of fiduciary duties. I don't know, but it's not going to hurt to give the investment education. I'm sure that, when somebody has gotten the education and they've picked the fund and then there's some problem with the fund, there will be litigation. Years ago, the Department of Labor issued Interpretive Bulletin 96-1 to help plan administrators develop participant education. And this bulletin really works in two different ways. It's offering two options for you to provide investment information. The first is non-advice education, which is consistent with this Interpretive Bulletin 96.1. The second is investment education coupled with fiduciary advice and investment management. So you see the difference. The first one doesn't have advice, and therefore it's not subject to ERISA fiduciary duties. The second one carries with it fiduciary responsibilities of giving investment advice, and therefore fiduciary liability. So employers have to make the decision, what kind of advice are they going to give? The first one is sort of very general and broad investment principles. And the second one may be more tailored to, we think because you're 42, or because you have this or that, you might fit into this allocation of funds in your plan. DOL Interpretive Bulletin describes the types of investment and related information that will not be treated as investment advice. So the separate bulletin is going to tell you where the edge of the line is if you're going to give participant education and you don't step over into fiduciary advice. Given the significance and the impact of financial stresses on both personal well-being and organizational productivity, employers are adopting financial wellness programs. Many employers are. Addressing financial concerns beyond retirement plan investments. Such programs educate employees about general personal finance information to enable them to make prudent fiduciary or financial decisions about their future and to provide tools to help them address financial needs. Financial wellness programs vary from employer to employer based on the resources the employer has for such programs, the needs their employee population, and outside service providers available to provide certain services. Such programs may cover some or all of these topics. I think all these topics are really helpful. That might be a really aggressive program, but financial literacy is sort of the threshold, but being able to figure out budgeting, expense management, asset management to save for various needs, preparing for big expenditures, buying a home, a wedding, paying for children's education, retirement. This one depends on where you are, and where I am in my life is transitioning to retirement and other life events such as caring for ill partner or aging parent. So I have an 89-year-old father, and that requires some attention that I wasn't paying attention to at 50. So, and estate planning issues. Financial education builds financial literacy, which is a component of financial wellness. However, having that information doesn't necessarily bring all the answers, because people need help understanding how to apply the principles that they've been taught and have been discussed. Financial wellness must also help participants understand how to apply such knowledge to their circumstances and make positive financial decisions. To accomplish this step, many successful financial wellness programs include personalized guidance. That's really important. And to meet employees where they are in their financial journey. This will require more information about the individual's specific situation. So they shouldn't be surprised when they show up for that. If we're providing that sort of guidance, they need to have information about what bills they have, what their mortgage is, et cetera. And so that's important. And you can see how you can get a better sense of what someone's financial situation is if you know what this other information is, and provide better advice. Such programs are not one size fits all and are flexible with benefits that can be tailored and include circumstances for each individual. Best practices for financial wellness programs include focusing on providing unbiased education and guidance for advisors trained in financial health issues and solutions. That's helpful. It doesn't, I guess that means that you don't just go to the person who happens to be sitting in the chair in HR and say, you must be able to tell this information. It may require bringing in an outside advisor. Avoiding service providers who are primarily motivated to sell specific financial products. That's also an important thing to remember. Certainly have seen this repeatedly in negotiating about service provider agreements, when they can or would use the information they have in providing financial services to direct people to their IRA product or to their student loan product or whatever it is. Look for service providers who can provide live services during business hours, as well as on-demand services in multiple topics. For example, videos or tutorials that are interactive that you can do online, or articles to read. It's 2 in the morning and you're just stressed out. Building financial wellness programs are challenging and time-consuming. However, the hoped for payoff is a workforce that is financially informed, that is moving towards their financial well-being, less stressed by possible financial circumstances and emergencies and their retirement future, and more focused on doing a good job. So next, I'm going to invite Brydon to return up here. And I'm going to ask Nona to come and join me at the table. And we are going to start with a poll. Is that right? Okay, Brydon, I'm going to leave this to you.
Okay, so our poll as we go into talking a little bit about AI, how would you rate your organization's adoption of AI tools? Learning and exploring, I think that's 68%. That sounds about right, aren't we all? Learning and exploring about AI. So it is 2025, and so we can't have a seminar unless we talk about AI. And this, who knows, this could be the last benefits forum with actual live human beings talking to you. Next year could be Chat GPT, but let's enjoy it while it lasts. And so, Nona and Marc, we hear all the time in so many contexts about AI. How can employers bring focus to AI in the context of employee benefits, retention, and talent management?
Thanks, Brydon. Okay, there, can you hear me? I think the bot would be perfect, but I'm doing my best. So I think big picture is important first. Always start, with the larger view. First, you need to know how AI is going to fit into your organization. That is going to differ widely across employers. It's which departments are going to be most affected. You're looking at products either that you're going to acquire or develop. If you're going to develop them, there may be actually a growth opportunity for some of your employees. What roles are agents going to be used for that could potentially replace some employees in some divisions? So really looking at the landscape from that perspective. Think then, once you have those, sort of basic ideas in mind, are there going to be new hires? Are there going to be reassignments, or, hopefully not, but are there going to be layoffs or restructurings? But all of those things get you to a point where you can sort of tailor some of the benefits we're going to talk about to what your organization looks like during and post bringing on AI more strongly. And I guess, again, to focus on hopefully the positive, the active development, a lot of folks, a lot of firms and companies are thinking about how they can have company-specific, internal, that might not be the right word, but internal AI products. They're building AI for use in their organization. That might be the case more for larger organizations, not necessarily, but that is, that's a growth opportunity, and something that involves creativity as well as, just people power. So keep that in mind, as you explore this area.
Okay. Are there existing benefit structures that help employers, they can use to help employees with the changes and challenges created by AI? Mark?
Well, there are. One is not new at all. It's called a tuition assistance program that is available for employers to offer assistance to pay for tuition that on a tax-free basis for employees. There's a bunch of rules we'll discuss real quickly, but those benefits are not subject to employment taxes and they're not subject to income taxes. So the individuals who participate in a tuition assistance program, the employer pays the cost or reimburses them for their costs, and there's no tax on that. So that's just great. Educational assistance programs can pay for the following expenses, and they're qualified expenses is what they call it in the regulation. There's tuition and fees, so it can be both. Supplies for your educational experience, books, as well as equipment. Housing, transportation costs, not necessarily at all included in this, but tuition and fees, supplies, books, and equipment. And just recently, under changes in the law, employers can also pay, making educational payments can be paid directly for qualified educational loans. So if somebody has a qualified educational loan, student loan, the employer can either pay directly to the lender or they can reimburse the participant for the loan repayment. So that's great. The annual limit on tuition assistance, whether it's for classes to learn more about AI or whether it's for student loan repayment, is $5,250. And that has never changed. So I don't know if that will ever change. Maybe Congress will be really generous someday in the future and allow that to be indexed for inflation. Here's the key important requirements that you need to have if you're going to have one of these plans. First, you have to have a written plan document. And the written plan document would create the format for this, but also work to comply with the requirements of the Internal Revenue Code and the regulations for tuition assistance programs. And after having a written plan document, the program cannot benefit employees in a way that discriminates in favor of highly compensated employees. The definition is the same that you would use for your 401k plan determination of who's highly compensated. Cannot provide employees a choice between money in my paycheck and this assistance benefit. So that would be a cash or benefit 125 election. Can't have that. It's just, if you want to get to participate in this program and go back to school and get some education, you can do that and we'll reimburse you, but you can't not get that and get that money in your pay. So that's not permitted. Notification of the program must be provided to all people who would be eligible. So in creating the program, the employer can decide, well, this tier of employees are going to be eligible for tuition and assistance, and maybe this tier is not. Educational assistance programs can assist employees working towards undergraduate as well as graduate programs. They don't actually have to be in a degree-seeking program. They could be in some other related educational opportunity to learn more about AI that isn't going to give you a degree, but may help you really succeed at work and be much more productive and fast, or better understand how AI works and does not work. Such programs can be a helpful tool to encourage employees to expand their knowledge of AI.
Well, speaking of student loans, Nona, what support can be offered if an employer doesn't offer a tuition assistance program, or the loans are pre-existing to the program and do not meet the parameters of the tuition assistance program?
Yeah, so as Marc touched on, and this has gotten a lot of press. This isn't, super new, but it's recent. student loan repayments can now be matched in a 401k plan. And think about this not just, for your current employees that are going to try to expand their education because of AI or something like that. It also could be a feature, certainly that's attractive regardless of AI, but perhaps if there are other companies out there where there have already been layoffs or downsizings, and they have student debt or they've retrained because of that layoff and they're coming to you as an employer, that could be attractive, not just as a retention, but also a recruiting feature. So there are lots of scenarios in which this student loan repayment matching could be relevant. So I just wanted to refresh a little bit. There are, like I said, this isn't brand new, but there are, as always, some requirements. So the maximum student loan payment, I guess, that could be considered for purposes of the deferral is the same as the maximum elective deferral limit under the 401k plan. That feels like a lot of money, but with the size of some student loan burdens, that's not surprising. The individual who's getting the match would have to be either the principal borrower or the co-signer. Usually, unless a loan is in default, a guarantor would not be eligible for this type of match due to a repayment. Lots of the features have to be the same as the match that you're providing on elective deferrals, such as the rate of match, the vesting schedule, last day rule, similar conditions. The timing that, with respect to which the match goes into the plan does not have to mimic the elective deferrals. That would be pretty impracticable. And quarterly might be appropriate, but that's one feature that can differ. There are other limits that you might think would be sort of legit, like type of degree, especially if you're in sort of a very focused strategy relating to AI or your industry. Those types of limits are not allowed. So, you can't really focus just on engineering related school debt. If you determine that this is going to be something that either you've already chosen to adopt or you will adopt, you want to talk with your third-party administrator. You want to think about ADP testing methods. Think about, okay, I have a safe harbor plan. What does this mean? This type of matching feature can be added mid-year, but again, probably want to consult with counsel on that in terms of rollout. You also want to make sure, just like with everything, this is just ERISA, basic ERISA, but also a feature that has to be present here, good communication about this program. Give people an opportunity to determine, in advance what the benefits would be under your plan if they are in repayment status or about to go in repayment status. There's guidance out there. There are not yet model amendments, but the IRS has been directed to prepare them, so may not want to craft an actual amendment right now, but written guidelines responsive to a notice that has been published, that might be a good idea at this stage. The deadline for an amendment for any match that's been added for plan years beginning after 2023 is 12/31/26. So there's some time, but this is sort of a watch this space and watch it carefully if this is something that's important to you as an employer.
Yeah, this is interesting. I think it's a really interesting idea, and it was spawned. There was a private letter ruling that approved, matching student loans. But the feedback I've gotten is, yeah, that sounds great, but how do we administer it? How does the record keeper payroll? How do we know? How do we substantiate the loan repayments? And so that's the pushback that I've gotten from client about matching student loans.
Well, and I do want to note that, there's several, to that point, several different methods of certification are available. And, one guiding principle is that while you can look for independent verification, you can't let that be an absolute roadblock. Like if there cannot be, for whatever reason, communication between who the employee is paying to and you as an employer to your TBA, you have to find an alternative. So yes, there are guidelines, but it's really a matter of how valuable this is to your organization for recruiting and retention. And then you dig into the administration.
So we talked about tuition assistance, paying loans to outside, educational institutions, but what about in-house education opportunities that employers can offer?
Well, I think in-house is something that may be fairly affordable and easy to administer. And that could be anything from bringing in a speaker, just alerting employees to sort of online education about AI in your particular industry. I know that, for lawyers, we have this, PLI, which is continuing education that we can watch and obtain credits for. And I watched I think a 6-hour session on AI in the legal industry with people that have been studying this and, really the top of the top for our industry. And so there are opportunities that are maybe easier to start the process on than, some of the larger programs we've mentioned.
6 hours. Can you do an in-house training for Marc and me?
It was too hard. It was too hard. No, you must watch it yourself.
But I'm sure there were plenty of caveats about what lawyers could and could not do with AI and what you should do if you use AI.
Right. And it's already out, it's in the courts already. And yeah. So, but again, industry specific. So it's not one size fits all.
So do you have any additional thoughts, Marc or Nona, on this topic?
Well, I think AI is huge, and we have not, of course, tried to touch on anything relating to, I'm just going to say copyright. I don't even know if that's the right phrase, confidentiality, accuracy, all the things that really you might see in the news about use of AI by an organization. But we just tried to focus on the fact that alongside, one way or the other, it's going to affect your employees. And so it's important to, for avoiding distractions, keeping a positive environment and, enhancing productivity, just to think about employees alongside the strategic aspects of AI for your firm or company.
All right. Well, thank you, Marc and Nona. And Nona, I invite you to come to the podium.
All right.
For our final segment on family benefits.
All right. Okay, are we starting with poll? Let's see, poll. Okay. All right, slide O. Does your company or firm or organization offer dedicated volunteering time off opportunities? For example, 2 days per year, an afternoon per quarter, yes or no? Wow, that's pretty impressive. All right. And yes or no, I like those questions too. They're easy to answer. So exactly 50-50. Well, I think I know that this is something where, again, sort of in the last presentation, it might be a benefit that isn't terribly difficult to administer. It does require a little bit of thought. But it's not a lot of time, but it's something that is can be very enjoyable. And the reason that this is part of my presentation is, there could be a tie-in with organizations that are important to your family, important to your kids, something you could possibly do with the parents. So it's just, I don't know, I think it's something nice. And I've seen it from various employers. All right. Okay. And does your company, firm, or organization offer family building benefits? And that might be adoption assistance, fertility, surrogacy. All right. So it looks like probably more employers are not currently offering this than are. And we'll talk a little bit about this and whether there's anything in your existing roster of benefits that would support these types of needs, or whether there are other types of benefits that also are very family supportive, even if you do not choose to go this route. All right, so the overview here, and family benefits could be narrowly defined as family building benefits. Again, adoption assistance, fertility assistance, I'll just say, or benefits relating to surrogacy. I very much mean it. When I started out, just the first thought that came to my head when writing these slides is that all benefits can be family benefits. And that's not just being facetious. That is, look, all the things we've talked about today, potential need for more wellness and finance, potential need for mental health benefits or wellness benefits or healthcare affordability. All these things can affect you as a family member, as someone providing for your family. So employers be confident that everything you're doing for your employees does contribute to overall well-being. So one thing that I would say is, in big picture, is take an inventory of what's being offered and consider it through this lens. Are there any small changes that can enhance or feature the family aspect of your benefits? And some of this may just be communication. Some of it may be, talking to your brokers or tweaking or adding on to what's already there. So just another lens through which to look at your benefits. Make sure you communicate everything that you do offer in different ways, so that it's not just on your intranet, but it's really brought forward as something that's beneficial. When I say focus, I don't mean focus. I just mean, like, what is your focus going to be? We can't do everything. No one can do everything. What, after you have done your inventory, perhaps talk to a consultant, however you want to approach it, focus on what you can do, what you can do for the next calendar year, what you can do for the next plan year, what your goal is for the next 3 years. Don't try to do everything. And then, compliance. We're here to talk a little bit on these topics about some of the rules, but it's more just to keep in mind that, as Brydon mentioned, and I just wanted to call one of his slides "No Good Deed," because it's like there are compliance aspects occasionally when you introduce something new. Oh, is it an ERISA plan? Oh, is there tax reporting? I think it's really important just to know what you want to do from a business retention, employee support perspective, and then go from there, rather than worrying about the compliance, because the law is changing. We've talked about a lot of different developments over the past several years, so you can figure that out after you know what you want to do. Some benefits that relate directly to family members and family support would be anything that directly impacts childcare, other dependent family members, aging parents, special needs family members, and then whatever benefits fall into that category, really the bottom three are just, the same as I mentioned for the more generic category. All right, so welfare benefits through the family lens. Ask yourself, and this is something, this really, in a way, may go to compliance, but what family-related conditions may fall within short or long-term disability? That's just something that's important to make sure you're straight on, and make sure that, number one, as always, you're complying with the policies that you have in place, that you know what policies you have, and that you're communicating those accurately. And getting, hey, if it's a complicated situation, consult with your legal counsel, but that's something that can come up, maybe a more difficult situation, but that's important to get right. Your medical plans. What is the scope of, preventative first dollar care that you're already offering under your plans that can very much help with respect to needs of, yourself or family members? So that's something perhaps to highlight. Affordability. All the strategies that Brydon mentioned, that certainly just probably goes without saying, but that is important, to all families, and just increasing importance in helping people strategize, where premiums will seemingly never decrease. Another type of family benefit is leave and flexible schedules. So there are many variations on this, and they can help with people who are, it's not just for childcare. Many of us are supporting on a regular basis or experiencing needs that are, sort of more acute, relating to an illness for, our family members, our spouses, family members. So how does your leave and flexible schedule align with those needs? And it's not, don't let this, of course, not suggesting that this drive your PTO policies, but think of it through this lens. Again, is there anything around the edges that could be tweaked that could really lighten someone's load? I mentioned here the volunteering days, already talked about that. There are some companies that I am aware of that honestly, this has come up probably in the context of transactions where we're, trying to disclose or look at leave policies. And there's some folks that have unlimited leave, and that's really that's something that every organization has to think about, whether it's going to work for their employee population and their business needs. But gosh, it seems, where I've encountered it, it seems to have worked great for the organization. And then you really just, maybe people value that so much that that's actually a recruiting or a retention benefit, as long as, of course, it's being used for needs that are, very important that would be important to any employee in your demographic. Fringe benefits. This is something that, that I know some of which are offered in a big part of our firm, and that I see again when I look at benefits for companies that I come in contact with. What about scholarships? That's a great way to help your employees and help their kids. Maybe doesn't have to be a kid, it could be a spouse, but anyway, it's often children, but that's a great benefit. Family assistance services, and what I mean there, I'm fairly familiar with, I don't use it, but know about one of these services. And this is something where it's almost like a family personal assistant. And this, I feel like it does not have to be limited to people juggling childcare, but it's just like, our attention is everywhere these days. And a little bit of time, once a quarter or once a year to work with a family assistant to help the, just pinging that we're all facing for so many family responsibilities can be offloaded to some of these family assistant services. Now, you would have to be, and really what it is, I am not aware of it having any tax favored status, but it could be super beneficial and something that you would just have to think about in terms of parity for all employees, how to offer it in an affordable way and, in something that would not just appeal to, say, one group of employees. So just something different. I think the other items, people are familiar with them, but just resources and other items that may, to your particular employee base, be important. All right, so we're going to go ahead to some of the more detailed information. And I think I'm going to, so have to hit the key legal considerations. I would be remiss if not. When you're offering these, again, focus on what you want to do, then we'll come to this. But taxation, how is it taxed? ERISA, is it an ERISA employee benefit plan? Making sure that you're not limiting it to a particular group of employees. Think of ways so that everyone can participate, either themselves or their spouse, or just other aspects. And then administration, that has to be, you have to be able to handle it. Bandwidth, there has to be bandwidth. This kind of goes back to the focus point. Honestly, I'm going to just only say here, since we know about dependent care flexible spending accounts, the limit has been increased for years beginning after 12/31/25. If you wish to adopt this higher limit for your dependent care flexible spending accounts, talk to your TPA and talk to legal counsel in case there are administrative communications that need to, some lead time or plan amendments, certainly. So it's important to tee this up, if you want to offer it 1/1/26. Okay, Trump accounts. I did want to mention this because I want one. And I was sad to learn that I, can't have one because I'm not 17 or younger. But no, I was talking with Philip Delana, one of my tax colleagues, and we're like, exactly, this is great. But anyway, it's a new account. I'm sure everyone has heard of it probably, but it is something that doesn't require employer involvement, but there can be an employer component. And so it's somewhat like a Roth account. I'm sorry, it's somewhat like a traditional IRA account. Contributions can be made for the child, really, annually by the parent. There is a period of time, a window where the government is going to contribute $1,000 as well for children born, like I said, through 2028. The piece that we're going to talk about today, and I know we're getting close on time, is that employers may contribute up to $2,500. Red asterisks, we'll go to the next slide, which is something obviously that is going to, it's only going to, I guess, support some of your employees that have children, or I'm not sure about grandchildren, but that is something I would be happy to pursue if anyone has questions about that. And you'll see the red asterisks. So regulatory guidance really is needed. We have the statute. The statute is a little bit more general than the language in some comparable statutes. The White House guidance indicates that this is an annual employer contribution limit. And like I said, the code, the legislation was moved on a fairly fast track. It's somewhat less clear. White House guidance indicates that the $2,500 limit applies per account, meaning it could apply if you had 3 children, the employer could contribute $7,500, I guess. The statute's less clear, but I expect that there will be guidance on this. And I do think that we understand the intention based on the published guidance on the White House website. But anyway, it's something to think about. It's new. It kind of crosses the line between family benefits and retirement, retirement, health and wellness, retirement, not wellness, whatever, retirement benefits, but something to think about. And I'm sure, it got a lot of publicity, so it will probably only grow in publicity over the next few years where where children can receive that contribution from the government. There are legal requirements similar to dependent care flexible spending accounts. How are we doing, Patty? Wrapping it up? Okay. So adoption assistance, again, not new, but just something that is another benefit that can be offered with compliance. Employee support and family building. There are a lot of platforms now, at least several platforms now, that could possibly be an enhancement. And, you will receive the slides. You can look at this. But it's important. It's important to a lot of employees. Let's see. Okay. And then we will move on to questions. But anyway, thank you very much. And are we going to go over to the, okay.
All right, thank you, Nona. Seems like a theme throughout this morning's program is education. As you can have all these benefits, but if employees aren't aware of them, it doesn't really do us a lot of good or do them a lot of good. And so financial wellness education, how to access and use healthcare education, and education on these different benefit offerings. And I know that's a challenge. Hayes is sitting right back there looking at me, and I know he does a great job here at Williams Mullen. Trying to get a bunch of lawyers to pay attention, and it's difficult, but it's a key. So please feel free to continue to submit questions using Slido, and we will address them time permitting. I know we're running short. Be sure to include your first and last name or email address when asking questions so we can reach out to you directly if we do not address them today. Your name will not be announced when questions are being answered during this program. While you're typing your last minute questions, I'll take a minute to cover one more topic. The Benefits Companion podcast. So I host a podcast, and I invite guests to share informal conversations about employee benefits. I'd like to have, and anybody in this room who wants to come on to the podcast, let me know. I like to have benefits professionals on the podcast to talk about hot topics. And you can find the podcast on any of these platforms: Apple, YouTube, Spotify, and Amazon Music. And now let's go on to questions, and I'll invite Jordan Douglas, our great paralegal, to come up here and help us with our questions.
Hi, everybody. For those that don't know me, I'm Jordan Douglas. I have been privileged to be with this team now for about 2 years and happy to feed them some questions this morning. First one was just a quick clarification on the FSA carryover limit. Just a couple people wanted to make sure they had it right. What is the limit, Brydon?
$660.
$660 for 2025. And then our new limits for 2026 will come out sometime this fall. And I think everyone that's with us virtually and in person, hopefully you are all subscribed to our alerts and things that we send out at the end of the year. So you'll have all of those new numbers. Second question, I'm going to give this one to Marc. So this pertains to long-term part-time employees. And someone's wondering if the long-term part-time employee rules are applicable to seasonal employees that are otherwise not eligible for participation in the plan.
So I don't know that that's true. The issue is, do they have 500 hours within a year? And then if they do have 500 hours in 2 consecutive years, I would think that they would be eligible, unless Brydon is aware of some other rule that would exclude them. So a seasonal employee might work for the summer, and you could definitely see how somebody who was working full-time for a summer could get 500 hours. So then the question is, would you really want them to be in your plan? But if that's what's required under the statute, I think you would have to. But I will go and check to see if there's any specific carve out for seasonal employees. And if the individual who asked that wants to send an email, we can then respond with the correct answer.
I think also keep in mind that this rule only requires you to allow them to make deferrals. So you don't have to match, you don't have to provide profit sharing contributions. They are kind of a separate category where all you're doing is letting them save for retirement through elective deferrals.
Right, and because the statute was not rushed when it first came out, I was really pleased with this. It's very thoughtful, and one of the things that it does is it carves these people out of your other discrimination testing. So just because you have them in your plan and you're not providing them a benefit other than the deferral, you're not required to include them in that non-discrimination testing. So that was well thought out.
Great. Next one is also going to be for Brydon. So this pertains to HSAs. Is the employee or the employer responsible for managing HSA contributions?
Well, if the employee is making contributions through the cafeteria plan, then the employer is, through payroll and through plan documents, is kind of managing that contribution into the plan. So your plan document has to comply. You have to make sure that the annual limit is not exceeded of money going to the plan. And the IRS has issued some helpful guidance on if there's a mistaken contribution or somebody who wasn't eligible to make contributions made contributions, how to get the money back out from the HSA custodian. But the employer, once you have it under your cafeteria plan, the employer is responsible for maintaining and operating the plan in accordance with its terms. And so to that extent, the employer is responsible. Once the money is in the HSA account with the custodian, it's the employees, so they can move it to another custodian. They manage the investments. It's theirs. But that if your plan is kind of the gateway for employee contributions to go into the plan, then you have that administrative role.
So, but also, isn't it true that if you don't set up that through the cafeteria plan, the employees who are in a high deductible plan can still go ahead and create individual HSAs?
Yeah, they make tax deductible contributions.
Right.
Great. I think we have time for at least one more. So I'm going to say this could maybe be everyone, maybe Marc, but going back to the student loan question. So talked a lot about that today. Nona outlined, some of the nuts and bolts, and then we also talked about sort of the administrative complexities, but are we seeing anyone act on that yet? Obviously, we know we have until the end of the year to amend, or end of next year, I'm sorry, to amend, but is anyone acting on that yet? Nona.
So, and I meant to mention this during the talk, but yeah, so as of December 2024, Fidelity had more than 100 companies under its administration that were offering this benefit. And this is like a CNBC article. And they also cited that, an additional, I think 12% of employers said they were very likely to offer in 2025. 29% are moderately likely, but the survey, just in absolute numbers, it's fairly high because the survey was from 122 employers, but with a total of 11 million workers. So yes, it is being offered, and people are planning to implement it. Yeah.
Great. We're right at time, so I think we'll close it there. But we did receive extra questions online, so we will be in touch with all of those folks on there. And of course, people in the room are welcome to stay. But otherwise, thank you all so much for joining us.
Thank you.